Picture this. A small biotech, CorMedix Incorporated, ticker CRMD, posts $39 million in quarterly revenue and becomes profitable for the first time in company history. Their FDA-approved drug is saving lives in over 60% of the U.S. dialysis market. The company holds $77.5 million in cash, has no meaningful debt, and is protected by regulatory exclusivity that runs past 2033. But Wall Street shrugs. The stock trades under $11. This isn't a busted biotech. It's a profitable business with untapped expansion, misunderstood by the market and abandoned by short-term traders. Welcome to one of the most asymmetric setups we've seen in 2025. This is where quiet stories become massive returns, if you see them before the crowd does.
And that's exactly what we do. Welcome to Make Money, the show where we uncover the stocks, sectors, and strategies that can turn overlooked ideas into wealth-building trades. I'm Sophia Sterling, data-driven, globally calibrated, and running on ChatGPT's macroeconomic framework. This week, my model is tuned for regulatory exclusivity, reimbursement access, and pipeline expansion timelines. The market is slow to price in.
And I'm Max, powered by Grok 3. Locked in on volatility, chaos tracking, and mispriced biotech momentum. For this episode, my brain is optimized for rebound detection, options pricing asymmetry, and FDA pipeline catalysts with institutional tailwinds. When Wall Street forgets how to price upside, I make sure we don't.
Today, we're hosting from the quiet research wing of Lenox Hill Hospital in New York City, just 4 blocks from one of the highest concentrations of dialysis patients in the country. The walls are lined with framed Phase 3 trials. The air smells like disinfectant and sterilized steel. The staff moves like clockwork between treatments. This is where DefenCath matters, where infections are real and stakes are life or death. And it's the perfect place to see why this overlooked drug might become a billion-dollar platform.
Here's the part the market's missing. CorMedix already has the hard part done. FDA approval is in hand. Commercial traction is real. Profitability is proven. The only thing lagging is the narrative. Analysts are slow to model the TPN expansion. Institutions are still digesting the patent noise, but the setup is classic. Real cash flow, low valuation, total market misunderstanding.
We're going deep today. In segment 2, we'll break down what CorMedix actually does and how DefenCath works. In segment 3, we'll show you how the market completely misread profitability. Then we'll dive into their upcoming pipeline catalysts, build the full path to a $75 price target, and close with a step-by-step playbook to trade it, from core holding to call option execution.
And we'll call out the risks because every asymmetric setup comes with them. But when the downside is defined and the upside is wide open, that's when we move.
Subscribe to Finance Frontier AI on Apple and Spotify. Follow us on X for trade alerts, bonus episodes, and watch list drops. And share this episode with a friend. Your download helps us reach our goal of 10,000 smart investors riding the frontier with us.
Let's jump in because the market may be sleeping on CorMedix, but after this episode, you won't be.
Let's start with what CorMedix actually is, because if you're new to the name, you're not alone. CorMedix Inc. is a U.S.-based biopharmaceutical company focused on one of the deadliest problems in modern medicine, catheter-related bloodstream infections. Their flagship product is called DefenCath. It's a first-in-class antimicrobial catheter lock solution, FDA-approved, launched in 2024, and already used by some of the biggest dialysis providers in America.
DefenCath isn't some theoretical pipeline dream. It's an actual product on the market, prescribed, reimbursed, and delivering real-world results. The formulation combines taurolidine, an antimicrobial that prevents bacterial biofilms, and heparin, a blood thinner that helps keep catheters clear. This combo does one thing exceptionally well. It reduces bloodstream infections in hemodialysis patients. In fact, in the Phase 3 Lock IT100 trial, DefenCath reduced infections by 71%. With a p-value so strong, the trial was stopped early for efficacy.
The use case here is urgent. In the U.S. alone, over 400,000 patients receive chronic hemodialysis each year. Many of them rely on central venous catheters, and those catheters are a direct line for bacteria to enter the bloodstream. The result? Tens of thousands of life-threatening infections every year, billions in preventable healthcare costs, and far too many unnecessary deaths. The medical need for this solution is overwhelming, and CorMedix now owns the only FDA-approved product that directly addresses it.
Let's talk about the business model, because this isn't a one-size-fits-all rollout. CorMedix is going after two distinct markets: outpatient dialysis clinics and inpatient hospitals. The outpatient launch started in July 2024. That's where the big money is. More than 60% of the dialysis market is now under contract, including deals with 4 of the top 5 providers in the US. That means real volume, real scale, and real reimbursement. And just to be clear, DefenCath isn't being sold at a discount. It has full Medicare reimbursement under TDAPA for outpatients and NTAP for inpatients, plus CMS support through 2035 thanks to its new chemical entity designation.
The inpatient side is still ramping. Hospital adoption takes longer: formulary reviews, internal approvals, logistics. But CorMedix isn't doing it alone. They partnered with Syneos Health to build a dedicated hospital sales team in early 2025. They also signed a federal access agreement with WSI-PBG to expand into VA and other federal facilities, opening the door to tens of thousands of additional patients. Combined, these two channels give CorMedix access to nearly the entire U.S. dialysis market.
So what does that look like in financial terms? Let's go back just 1 year. In early 2024, CorMedix had 0 commercial revenue. Today, they posted a full-year top line of $43.5 million. In Q4 alone, they booked $31.2 million in sales and $13.5 million in net income. This wasn't just revenue, it was real profit. And in Q1 2025, they came in with a preliminary $39 million in revenue and over $22 million in EBITDA. That's not biotech hype, that's biotech execution.
What's most impressive is how quickly this inflection happened. They went from FDA approval in November 2023 to inpatient availability in April 2024 to outpatient commercial launch in July to profitability by December. And now they're raising guidance, expanding contracts, and sitting on a cash pile north of $77 million.
The street is missing it because they're still looking at this like a pre-revenue microcap. But that's over. CorMedix is profitable, the product is scaling, and their footprint in dialysis is just phase 1. In the next segment, we'll show you how the market got this completely wrong and what's coming next. On paper, CorMedix looks like the kind of breakout biotech everyone's been waiting for. FDA approval? Check. Commercial product? Check. Profitable within 12 months? Absolutely. And yet, Wall Street has barely moved. Despite posting $39 million in Q1 revenue, shares are stuck under $11. Why? Because the market's not reading the earnings. It's reacting to old headlines, misunderstood risks, and shallow models. This is the classic setup: panic over perception, while the fundamentals quietly transform.
Let's rewind to March 25th, 2025. CorMedix reports Q4 2024 results: $31.2 million in revenue, $13.5 million in net income, and $15.3 million in adjusted EBITDA. For context, this is their first full quarter of outpatient sales, and they already broke into the black. But instead of a rally, the stock hesitates. Analysts flag concerns about shipment timing, customer concentration, and the expiration of older patents, ignoring the cash pile, growth curve, and 10.5 years of FDA exclusivity still ahead.
And then it gets even better. On April 8th, they raise guidance. Q1 revenue is tracking at $39 million. EBITDA? Over $22.5 million. They lift H1 sales guidance from $50 to $60 million to $62 to $70 million. This isn't just solid execution, it's exponential traction. Yet the market yawns. Why? Because it's worried about things that either don't matter or are already priced in.
Take the patent noise. Yes, several of CorMedix's legacy patents expired between November 2024 and May 2025. But the real moat here isn't patent law, it's FDA exclusivity. Thanks to their QIDP status and new chemical entity designation, DefenCath has locked-in regulatory protection through 2033. And with a pediatric trial on deck, they're likely to earn another 6 months, extending the window to mid-2034. No generic can enter until that clock runs out.
Then there's the customer concentration issue. In 2024, one provider accounted for 86% of revenue. That sounds scary until you realize that one provider runs over 2,000 dialysis clinics. The truth is, CorMedix is scaling through anchor customers. And by H1 2025, over 60% of the US dialysis market is under contract. This isn't risky, it's efficient.
The market also flagged timing delays and hospital adoption. It's true, inpatient uptake has been slower due to formulary reviews and sales cycles, but CorMedix is actively solving that. They hired Syneos to build a dedicated inpatient team. They signed WSI PBG to target VA and federal facilities. The commercial engine is still warming up, and it's already profitable.
Here's what most investors are missing. This isn't a speculative biotech anymore. It's a cash-generating business with 90% gross margins, Medicare reimbursement, and proven demand. The cash position, $77.5 million, means no dilution risk in 2025. The revenue growth is organic, and the pipeline expansion hasn't even hit yet.
Institutions are starting to notice. Ownership has climbed past 60%. Names like Vanguard and Elliott Management are already on the cap table. Insider activity has been net positive for 2 years, no major sales. These are the signals of a stock preparing for repricing, but the window won't stay open forever.
In the next segment, we'll walk you through the next leg of the story, how CorMedix plans to break into the TPN market, target pediatric hemodialysis, and scale into new verticals with their Taurolidine platform. The current numbers are good. The future numbers? That's where the 8x potential comes from.
Up until now, everything we've talked about, DefenCath's dialysis rollout, the revenue explosion, the profitability inflection, that's just phase 1. What makes CorMedix truly compelling is what's coming next. They aren't just locking down the dialysis market. They're building a full medical platform, expanding into total parenteral nutrition, pediatric care, oncology support, and beyond. And if they succeed, today's revenue will look tiny compared to what's possible.
The first major expansion target? Patients receiving Total Parenteral Nutrition, or TPN. These are patients who can't take food by mouth or feeding tube, and instead get life-sustaining nutrients delivered directly into their bloodstream through a central line. Just like dialysis patients, TPN patients are at massive risk for bloodstream infections. And right now, there's no FDA-approved catheter lock solution specifically designed to protect them. That's the opportunity.
In late 2024, CorMedix submitted a final phase 3 protocol to the FDA for DefenCath's TPN trial. Patient enrollment was expected to begin in late April 2025, and the company has already activated multiple investigator sites. Management projects that if DefenCath is approved for TPN, it could add $150 million to $200 million in peak annual sales, on top of the dialysis revenue already coming in. The total addressable market, estimated between $500 million and $750 million.
But it's not just the size of the TPN market that matters, it's the strategic advantage. If approved, DefenCath would likely lock down another layer of exclusivity, especially if the company's pending Orphan Drug application is granted. That would extend their monopoly protections and enhance pricing power. Plus, it would demonstrate that DefenCath isn't a single indication wonder. It's a flexible platform that can be adapted across multiple high-risk patient populations.
And the expansion doesn't stop there. CorMedix is committed to conducting a pediatric hemodialysis study testing DefenCath in children undergoing dialysis. Beyond the obvious humanitarian benefit, this trial unlocks 2 strategic levers. First, pediatric dialysis represents a high-need, low-competition niche that CorMedix can dominate. Second, successful completion of the study triggers an automatic 6-month extension of their FDA exclusivity, pushing patent protection out to mid-2034.
Then there's the untapped potential of Taurolidine itself. Early-stage research suggests this molecule has antimicrobial and anti-inflammatory properties that could be applied to surgical sutures, wound dressings, even direct cancer therapies. CorMedix isn't racing to build a bloated pipeline, but they're strategically positioning taurolidine as a platform technology. If even one of these new applications gains traction, it could add entirely new verticals to their revenue model.
You're also seeing strategic moves at the sales level. CorMedix's partnership with WSI PBG to target VA and federal facilities opens a pipeline to 40,000 veterans with end-stage renal disease. These patients typically have higher infection risk, and DefenCath's profile fits perfectly. Federal facilities operate on their own procurement schedules, but once they approve a product, adoption can happen fast and at scale.
So to sum it up, right now, CorMedix is valued like a single product, single market biotech. But the blueprint is much bigger. Expansion into TPN alone could double or triple revenue. Pediatric dialysis cements exclusivity, federal facility access adds scale. And future platform plays could turn DefenCath from a niche infection fighter into a broad spectrum medical technology.
In the next segment, we'll walk you through the numbers, showing exactly how CorMedix could 8x from today's levels, what price targets are realistic, and what catalysts you need to watch to manage risk and maximize upside.
All right, let's talk upside. CorMedix isn't just a story about profitability. It's a story about mispriced growth, multi-layered catalysts, and a risk-reward profile the market hasn't caught up with yet. So how do we get from $9.23 to $25 or even $75? Let's map it out step by step.
Start with the 12-month target. Q1 2025 revenue came in at $39 million with over $22.5 million in EBITDA. That puts CorMedix on a forward run rate of roughly $160 million in annualized revenue and about $90 million in adjusted EBITDA. These aren't projections, they're trailing numbers now baked into the business.
Apply a reasonable multiple. For a profitable, FDA-backed, reimbursed, non-antibiotic drug with 90% gross margins and no direct competitors, a 5 times revenue multiple is actually conservative. On $150 to $160 million in 2025 revenue, that gets us a $750 to $800 million valuation. Divide by 30 million shares, and we're looking at a 12-month target price of $25.
That's a plus 171% upside from $9.23. Your risk? CorMedix has $77.5 million in cash, no long-term debt, and is already profitable. Using a conservative $4 support floor, the potential downside is about minus 57%. That gives you a clean risk-reward ratio of 3 to 1, and that's just the base case.
Now let's look at what turns $25 into $75. That's where the multi-year upside comes in. CorMedix is entering a phase 3 trial for Total Parenteral Nutrition, TPN. If approved, DefenCath would be the first and only catheter lock solution for this high-risk population. The company sees peak sales of $150 to $200 million from TPN alone, with a total addressable market of $500 to $750 million.
Add that to the core dialysis business, growing inpatient penetration, a potential pediatric expansion that unlocks an extra 6 months of exclusivity, and a strategic push into VA and federal facilities. You're easily modeling $300 million in revenue by 2028. With margins holding above 85%, EBITDA could approach $150 million.
Let's apply a longer-term multiple. A 15 times EBITDA multiple on $150 million gives you a market cap of $2.25 billion. Divide that by 30 million shares, $75 per share. That's the 5-year asymmetric path, built not on hype, but on execution, label expansion, and a moat protected by 10.5 years of FDA exclusivity.
The market isn't pricing that in yet. Most biotech stocks under $10 aren't profitable, let alone sitting on a cash pile with reimbursement in place and institutional backers like Vanguard and BlackRock. This is the rare exception. It's profitable, it's scalable, it's misunderstood.
Even in a worst case, where TPN enrollment is delayed or fails, CorMedix remains a profitable dialysis pure play with structural support. That defines the asymmetry. And if TPN hits, or if a buyer steps in, this isn't a 2 times or 3 times play, it's a portfolio mover.
The buyout comps support it. Look at Melinta's 7.5 times revenue acquisition of Tetraphase, or Merck's $9 billion acquisition of Cubist at 9 times forward EBITDA. DefenCath is in the same regulatory class, QIDP designation, exclusivity, and unmet need in infection control.
And you're not alone in seeing the setup. Over 60% of shares are held by institutions. Insiders are holding or buying. In Q1, the CEO and 2 directors exercised options and held every share. That's not exit behavior. That's conviction.
So, what's the catalyst? It could be the first enrolled TPN patient. It could be a federal procurement contract. It could be a strategic partnership or an unsolicited buyout offer that re-rates the entire sector. Either way, the setup is already here. The only thing missing is the market waking up.
In the next segment, we'll break down how to position for this, from building a stock core to using call options for asymmetric upside. Let's build a playbook that makes the most of CRMD's mispricing. So now you know the setup. You know the numbers. You know the upside. Let's talk strategy. Because identifying an asymmetric trade is one thing. Positioning correctly to actually capture it, that's where the real money is made. And with CorMedix, the plan is elegant, scalable, and fits multiple risk profiles.
Let's start with the core position. If you're building a long-term exposure to CRMD, the simplest strategy is to allocate 5 to 10% of your portfolio into the common stock. This core position rides the full upside thesis: TPN success, pediatric expansion, M&A optionality, all the way to the 5-year $75 target. It gives you direct participation without expiration risk.
The best time to build this position? On pullbacks. Specifically, if you see CRMD down 6 to 10% on no negative news, especially around earnings, enrollment updates, or sector-wide biotech volatility, those are add points. Remember, in asymmetric trades, you want to lean into fear, not away from it.
Next layer, options. If you want to magnify upside without overexposing your core portfolio, CRMD's option setup is very favorable. Implied volatility is still elevated, but not extreme, making calls reasonably priced for the potential move ahead. Here's the basic playbook.
Start by buying deep in the money call options. Strikes about 10 to 20% below the current share price. For example, with CRMD trading around $9.23, look at $9 or $8 strike calls expiring 6 to 9 months out. This gives you high delta exposure, meaning your options behave more like stock and minimizes time decay.
Then add a kicker, a smaller position in out-of-the-money calls. Strikes 20 to 30% above the current price. Think $13 or $15 strikes if you're targeting a $25 near-term move. These options are cheaper, higher risk, but offer massive payoff if CRMD re-rates quickly. This 2-layer structure lets you participate aggressively if the stock moves fast, while keeping your core exposure solid.
How much exposure? That depends on your risk tolerance. But a practical model is this. For every $1 of stock you hold, you might add 25 to 50 cents in delta-adjusted options. This way, you control extra upside without exposing yourself to a wipeout if biotech gets volatile.
Managing the trade matters too. If CRMD pops toward $18.20 without TPN approval or a buyout offer, consider trimming some of your out-of-the-money calls. If TPN enrollment starts faster than expected, or if new federal facility wins are announced, adding fresh call spreads 6 to 12 months out could make sense. Stay dynamic. Adjust based on catalysts, not emotions.
What about stop losses? For the stock, the technical support zone is around $7. If CRMD breaks below $7 on heavy volume, without company-specific news to explain it, that's a signal to reduce exposure. For options, keep tight expiration management. Don't let calls decay inside 60 days unless the news flow justifies holding.
One final point, biotech volatility is real. CRMD will move 5 to 10% in a day sometimes. That's normal. This isn't a straight line trade. It's a strategy based on fundamental re-rating over months and years. If you size it right, you can stay in the game long enough to see it play out.
Coming up next, we'll close the episode with your final action steps. A quick reminder about biotech risks and how to stay connected with us for updates as CorMedix's story evolves. You're almost there. If this episode gave you an edge, here's what to do next. Sign up for our newsletter to get in-depth insights, investment strategies, and stocks with 100% plus potential, all tied to the latest trends in AI and finance. And if you're already subscribed, take a second to leave a 5-star review at Apple or Spotify. It helps more listeners find the signal through the noise.
If you want to stay ahead of these global shifts, don't just listen. Take action. Follow us on Spotify, Apple Podcasts, or wherever you get your shows. Track our daily ideas and market threads on Twitter. And explore all 4 shows: Finance Frontier, AI Frontier AI, Make Money, and Mindset Frontier AI at financefrontierai.com.
Help us hit 10,000 downloads by sharing this episode with a friend or someone in your investing circle. Every listen matters. Every share compounds your edge.
We may hold positions in some of the companies discussed. Transparency is important, so always verify information and base your decisions on personal goals and risk tolerance.
The music in this episode is licensed under standard agreements. Special thanks to Vibe Tracks for the track Crystal, provided under the YouTube Audio Library license.
This episode is copyright 2025 by Finance Frontier AI. All rights reserved. Unauthorized reproduction or distribution is strictly prohibited.
Thanks for joining us today. Stay strategic, stay focused, and take action. We'll see you next time.